Have you ever wondered how to minimize your tax bill through investing? It's a question that plagues many an investor. Well, there's a strategy that can help, known as tax loss harvesting. It's not some arcane financial magic. It's a practical approach used by savvy investors to lessen their tax burden. It's about turning investment losses into opportunities, giving a silver lining to every financial cloud. Intriguing, isn't it? Let's explore this concept, shall we? To understand tax loss harvesting, let's first break down the term. Tax here refers to the mandatory financial charge that you pay to the government. Loss indicates a decrease in monetary value, especially in terms of investment or market value. Harvesting in this context means realizing or bringing to actuality. So put together, tax loss harvesting is the practice of selling a security that has experienced a loss. It's like plucking an apple from a tree. But in this case, the apple is an investment that's dropped in value. By realizing or harvesting this loss, investors are able to offset taxes on both gains and income. In essence, tax loss harvesting is about transforming the bitter lemons of investment losses into a sweet lemonade that can potentially reduce your tax liability. Sounds complicated? Don't worry, we will break it down even further. Now, let's delve into how tax loss harvesting works. Imagine you're an artist with a palette of different investments. Over time, some colors may lose their vibrancy, representing investments that have dipped in value. This is where you begin the process of tax loss harvesting. Firstly, you need to identify these underperforming investments. These could be stocks, bonds, or any other assets that have depreciated since you've bought them. It's like noticing the fading colors on your palette. But it's not enough to just identify these losses. The next step is to sell these investments, thereby realizing the loss. Think of it as cleaning your palette, washing off the faded colors. This action is beneficial because it allows you to offset the taxes on both your capital gains and income. However, we don't stop there. Now, you replace these sold investments with similar ones. This might sound counterintuitive. Why would you buy something similar to what you've just sold at a loss? Well, the idea here is not to change your investment mix or your expected returns. It's simply about maintaining your optimal portfolio allocation. Think of it like replacing the faded colors on your palette with similar but fresh colors. You're still painting the same picture, but you're doing it more efficiently. This replacement step is critical because it ensures that your portfolio stays balanced and geared towards your long-term financial goals. It's like still being able to paint your masterpiece, despite having had to replace a few colors along the way. So to summarize, tax loss harvesting is a three-step process. Identify the losing investments, sell them to realize the loss, and then replace them with similar investments. This strategy can help reduce your taxable income and potentially increase your after-tax returns. And most importantly, it's a way to turn a negative, the loss of value in part of your portfolio, into a positive by reducing your tax liability. Remember, the goal here is not to change your investment strategy, but to use losses to your advantage. Before we conclude, here are some key points to remember about tax loss harvesting. Firstly, tax loss harvesting is a strategic move that can help you manage your investment portfolio more efficiently. By selling off investments that have declined in value, you can offset the gains from your profitable investments, reducing your overall tax liability. It's like turning lemons into lemonade. You're making the best out of a not-so-great situation. However, it's important to remember that tax loss harvesting is not a one-size-fits-all strategy. It's best suited for investors in higher tax brackets or those with significant capital gains. If you're a young investor just starting out or someone in a lower tax bracket, the benefits may not outweigh the costs. Moreover, tax loss harvesting is not without its risks and complications. There's the wash sale rule that prohibits you from purchasing a substantially identical investment within 30 days before or after the sale. Then there's the potential for higher long-term capital gains taxes if you repurchase the same or similar investment. Finally, remember that tax loss harvesting is an advanced strategy that requires careful planning and expert advice. It's not something to jump into without fully understanding the implications. So there you have it, a simplified guide to tax loss harvesting. Now you're a step closer to becoming a smarter investor.